Good afternoon, everybody, and welcome to the BDSM show. This is a brand new show where we talk about budgeting, diversification, savings, and all things money. Probably not the BDSM you're expecting, I know, but nevertheless, it will be fun. Just a quick sound check. If you guys can hear me, please type in yes onto the chat panel on the right-hand side, and we will kick off very quickly. But while we're doing that, while waiting for you to confirm that you can in fact hear me, this show is part of our new and exciting B project, which you'll be hearing all about before this year is out. My name is Ivan. I'm still your host today. Clearly, I didn't get enough complaints to kick me off last week. And just in case, all advice today is in fact general only. Today, my guest's name is Jonny Wilkinson. Welcome to the show, mate.
Thanks, Ivan. Thanks for having me, mate.
Well, thank you for coming. Quick introduction. Jonny shares the name of one of the best-known rugby players, as I keep reminding him of multiple times. Every time we talk. The guy, by the way, if you don't know who Jonny Wilkinson is, he drop-kicked the winning goal against Australia in the 2003 World Cup, and I'm still pretty bitter about that. Unlike the evil Englishman, though, this Jonny is one of the most forward-thinking visionaries in the Australian fintech space. Jonny is a member of the Federal Treasurer's Fintech Advisory Group, which was set up by Malcolm Turnbull. And pretty much as far as I understand, that group, I never get invited to these things, but that group tells the government that fintech has nothing to do with digging shit out of the ground, a concept that I believe they're still struggling with. The last 6.5 years, he has dedicated to revolutionizing how investors find and fund cool Aussie and Kiwi startups, which is something called crowdfunding. Jonny, for newbies in the room, what is crowdfunding?
So equity crowdfunding is a way of making an offer of securities for unlisted companies to everyday investors or retail audience. So we needed to change some laws that allowed for an exemption for unlisted companies to raise money in a particular fashion. So any companies that have less than 25 million assets and turnover, if they go through a licensed platform like ourselves, if they make a registered offer using an offer document, which is like a cut down version of prospectus, if they meet all the sort of tests and checks and balances, they can raise up to $5 million every 12 months. From everyday investors. Retail investors are limited to investing no more than $10,000 into any one company every 12 months. And that's it. So it's a great avenue for everyone to access startups. The way we view it is it's a new asset class. Everyday investors, or even, most of us, unless you're looking to invest $250,000 into a VC fund, you couldn't really get exposure to this. If you're an angel investor, you might, have been able to invest $25,000 into the odd deal here and there. But generally speaking, it's not something that's been widely accessible. We've pushed for that to become the norm in Australia and New Zealand, and it's largely been following some regulations and some evolution in the US, UK, and some other Western securities markets.
You were like one of the first companies to get a crowdfunding license. I remember talking to you a little bit after that. And so I think you got it in New Zealand, then it came into Australia. And then you, like the day that it went live, I think you put you had a raising on the platform, right? Yeah,
so we kicked off in 2014 and went through what's now the H2 Ventures Accelerator program. And at that point, the government was reviewing the legislation. That was Labor government. There was a change of government, and it became very obvious that the legislation was going to drop off or take some time to pass. So my business partner and founder, Chris, and I jumped on a plane, went to New Zealand where they'd already changed the laws, came back, quickly realised the opportunity was to go there first, and then we got set up and licensed over there. Then we turned our energy back to lobbying the government to change the regulations and legislation in Australia. So we got, there was six other parties that got a license, and we got the license of the 11th of January 2018, and we launched the very first deal for Xinja on that same day.
Yeah, cool. Equitise is one of those businesses that I have always, like when people talk about crowdfunding, it's your business that they talk about. I wasn't even aware there was 5 other parties that got licenses at that same time.
Yeah, look, we have been trying to do it and doing it in various forms since 2014. So before we could go out to retail investors, we were doing it for your traditional sophisticated wholesale investors, and in New Zealand. So yeah, look, I mean, it was obviously by virtue of being there from the beginning, being involved with lobbying the government to change the laws. Our brand's been out there, and my team's done a great job of doing that and keeping it going. And we've now done, I think, 83 raises and raised about $50 million over the past 5 or 6 years, which is great, good testament. And yeah, just intending to keep on growing things and get more investors on the platform and get more great companies funded. So hopefully our name will remain synonymous with equity crowdfunding. Yeah.
I'm sure it will. And there's some pretty impressive numbers, and especially, obviously, as soon as you start having those companies that, like the Xinjas of the world that are coming from a crowdfunding to bigger raises to listings to, that entire process takes what, 5, 6, 7 years?
Yeah, look, it can be anywhere from a couple of years if things go really well, and depending on the stage company is raising money, to upwards of 10 years in some instances, where sort of from cradle to grave, or from when the company forms to when they list or acquired or whatever happens. So yeah, look, it is definitely a sort of a medium-term horizon, which is an important part of sort of how we educate and get people to analyse and assess these deals. And where we can, we try and make it as obvious as possible what the intentions are for listings and those sorts of things. For instance, we've got 2 live Australian retail crowdfunding deals on at the moment. One of them has a planned listing in the next 6, 12 months. And then there's another one that might not list for 5 years. So it just depends on the company and the stage and what their strategies are.
So tell me something, how did this happen? So you woke up one day and you said, you know what, right, I'm dedicating my life to crowdfunding. Like, most people want to become police people and firemen. Like, how do you wake up and want to become a crowdfunder?
Sure. So look, I come from sort of a bit of a family of entrepreneurs on both sides, and then the others are doctors or medicos. I didn't want to work hard to become a doctor or a lawyer. I'd always had in mind that I'd probably do my own thing. I had that kind of entrepreneurial buzz. So, I went to uni, got in and out as quick as I could with an economics degree. And then I started working at Citi in equity markets. So I did that for about 6 or 7 years. I'd always had a particular sort of bent for your more early stage, high growth and biotechs. That's what I spent most of my time looking at. Less interested in your sort of ASX 50, ASX 200. So, I always had a bit of an eye to that end of the market. And it became obvious, I was, looking at biotechs, and particularly many Australian biotechs have amazing research, but when time comes to fund it and develop it, they're pushed to list very early, and often that's to the detriment of the company, subsequently the shareholders, and then the success of the business, because, if they list too early and they're sort of at phase 1 or 2 and there's a long time between any sort of news or any major inflection in value, your share price can drift down. They need to go raise more money, continue things, etc. They do it at depressed valuations, all those sorts of things. So, that made aware to me that there was problems with early stage capital markets and venture capital in Australia. And when we were looking at doing this, identified that there was an area of the market that was broken, and we've got this view, and our North Star is to make early stage capital markets more efficient, and to make it accessible for everyone. So, we want to see more great companies get access to funding, and ideally, a lot of them might delay having to list because there's other sources of capital, and they can grow better as a private company, and then when time's appropriate, they can list, and ultimately that delivers better returns to shareholders and stakeholders.
And, do you see any stats around how many people are investing in early stage pre-IPO of early stage to pre-IPO deals? Because obviously they're an extremely lucrative investment if you get it right. Are we seeing an increase?
Yeah, look, I suppose the data is a bit hard to sort of really pin down. Anecdotally, I suppose the kind of way to talk about it or understand is, maybe 10, 15 years ago, people are at dinner parties talking about, what small listed company they may have, invested in, or they've heard about something, yada, yada, yada. These days, it's very commonplace to hear about someone talking about investing in a startup or an unlisted company that may indeed, not be your traditional pre-IPO. It's going to list in the next sort of 6 to 12 months. But the startup or it's more of a seed Series A funding angle. So yeah.
Man, I want to get invited to your dinner parties. At my dinner parties, we talk about Bachelor, man.
BDSM.
Hey, look! It's all PG here.
Sure. Yeah.
How did you know?
Budgeting. Yeah.
It's it's when you get to a certain age, you just talk about it. So there's sort of, I guess, two paths for a lot of people to get into early stage, and one is to go via like invest in a fund. If you're a sophisticated wholesale investor, there's a lot of those guys, like VC type funds that are coming about. Why would you go through? I mean, it's a lot more labor intensive to go on and go through crowdfunding, source your own deals, find the deals, invest in those deals. Do you think it yields to better results for the client?
Yeah, look, I mean, the analogy is maybe this is the difference between like an active listed fund manager and a passive manager. We very much extol the benefits of having obviously a diversified play at the particular unlisted space. So we would say, if you're looking to invest $20,000 per annum, put $1,000 into 20 companies. And there's some research, a decent amount of research that goes to prove that the probability of getting an IRR greater than 25% is exponential as you start to put more of these companies in. So definitely at your seed Series A, it's very hard to pick winners, and it's much better to take a portfolio approach. Obviously, as some of these companies get a bit bigger and having access to them and all these sorts of things, which is not the area we tend to play in, which is, like your Canvas or some of those sorts of companies. Definitely having funds invested in a VC or active manager in this sort of instance is a good way of getting exposure. So yeah, look, I mean, as you point out, if you're sitting there trying to do it all yourself and trying to pick all the winners and put a lot of time and energy into it, by all means, it is an effective way of we present it as an apples for apples, so you can sort of compare things. And we do obviously sift through a lot of companies before they even come onto the platform. So about less than 10% of what comes to us gets up on the platform. But yeah, generally speaking, I mean, if you've got a good amount of money and you're trying to sort of invest a lot and pick some winners, I would suggest your traditional investor would probably either be doing it directly and get access to deals, and they might be part of an angel group or something like that, or they're just high net worth that gets access to deal flow, or they're going to park a reasonable chunk of cash with a VC fund or a few funds that might be going after a particular size, sector, stage, or thematic.
You mentioned a couple of words just quickly, just for those that don't know. So can you explain IRR and what that actually means? And also you talk about seed, Series A, Series B, I think you mentioned as well. And
yeah.
Sort of goes further. What are those terms to the people that buy BHP and sell it?
Apologies, yeah. So IRR is internal rate of return, and it's a metric that's used particularly in your more sort of unlisted private equity venture capital space, and it measures the compounding return over a period of time, and often that is the case because it might be a 5-year horizon, and it's a more accurate reflection of the returns, rather than saying year on year the fund returned 10%. So it's a bit more of an accurate reflection, and mathematically, I think, obviously smooths where there may be no general paper returns or anything to show over time what your annualized rate of return effectively is on these sorts of investments. Series A, Series B, seed in sort of startup venture capital refers to the size and particularly the stage that companies are raising money. In the US, it's a little bit more defined and well trodden. Even then, in the past 5 years, it's kind of moved away from what was considered the norm. But generally speaking, most companies will raise or bootstrap, and bootstrap is basically when you fund it out of your own pockets, raise the money from friends and family or a few small angel investors. Then they might do a seed or a pre-seed raise, depending on sort of where they're at or how much it is, and that might be a couple $100,000 to $1 million. Excuse me. And then they might do a seed or a Series A, which is likely to be $1 million to maybe $5 million in Australia. Maybe up to 10. In the US, it can be anything more like 5 to 20 million. And then
is that million or billion?
Million. And then your sort of Series B, C, D goes on from there, and it's your larger chunks of capital, and that is the real sort of unlisted venture capital and private equity sort of space.
Interesting. And we are just running a poll, by the way. So there's like a little red button. Have you ever invested in startups before? So far, 62% have said yes, which is good to hear. They're probably, a lot of the people actually probably know about your platform already. So you mentioned this sort of all these different, and I assume that on the platform, you do get all sorts of different levels raising. What's the minimum amount that someone can invest in a deal?
Sure. So look,
typically.
Typically it's probably about $250 is the minimum investment in one of the companies we're raising money for. It can be a bit lower. It can be sort of 500. It just depends on the raise and the company. If it's an IPO, obviously the minimum is normally $2,000 or a bit more, depending on marketable parcels, sizes, etc. But yeah, we're big believers in trying to make it relatively accessible and doing it in a way that everyone can invest a reasonable amount and participate. So yeah.
Interesting. So that means that really you can get a you can have a $10,000 portfolio, invest in a bunch of different companies, literally diversify your portfolio. I mean, to buy an ASX stock, you could have $500 minimum. What are the fees associated for the client in putting money into, say, Xinja early stage?
Sure. So we don't charge investors any fees. If you try and pay with a debit card, there's a small transaction fee. But otherwise, we don't charge any investors any fees. It's all on the company. So in that sense, it's obviously quite exciting, and we're not trying to charge brokerage, so you don't need to factor that into your investment, and that's why we can have people invest relatively small sums of money. So yeah, so we try and make it sort of as easy and accessible as possible. Yeah.
So on the poll, 53% have in fact invested in startups, 46, so about half. So tell me, so this actually sounds awesome for a lot of investors. Why don't more people do crowdfunding or talk about crowdfunding?
To be honest, it's probably a function of a couple of things. Traditionally, the ASX has been a pretty well-performing early-stage capital market, and people have been able to access, and a lot of companies have listed quite early. And as I said earlier, maybe to the detriment of the long-term success of the business and shareholders and returns. Also, it's pretty new, so it's only been in play since 2018. These sorts of things obviously take time for people to understand, Under the legislation regulations, we're kind of limited in the advice we can provide to people. It's not on approved product lists at this point, so it's not as though advisors A, know about it, or B, sort of talking to their clients about it. Yeah, look, it's just one of those things that it's a matter of time as more important people become aware and understand what it is and where it fits into a portfolio. We often, when we're doing deals, less and less so now, we get questions, when's the company going to pay a dividend? How do I sell my shares on the exchange, all this sort of stuff. So, it's a matter of educating people that obviously most of these companies are your more high growth, early stage ventures where they're going to reinvest profits rather than pay dividends. And then things like, most of these companies aren't listing, so there may not be a direct avenue to buy and sell shares. But watch this space. We've actually got a product we'll be rolling out in the not too distant future that allows some secondary trading for some of these companies. Yeah, so it's just people need to kind of understand more and get more exposure, and over time, that's how you get obviously wider adoption and participation. That's
cool. You need to tell me all about your secondary market tool. I'm sure we can do something together there. So one thing you said, 10% of the deals will actually come through. How do you guys run DD, and how do you check who gets onto the platform and who doesn't?
Sure. So look, in many ways, we're kind of like a venture capital firm in the sense that we have our website and people can just come and apply direct via the website. We've got a form, we collect information, we ask for a pitch deck, and then we get referrals from our networks, from lawyers, accountants, advisors, brokers, people that are involved with these companies. Existing investors, obviously, a great source of referral. So they say, oh, look, we're raising, $1 million for this company. Us existing investors have already put in $500,000. We think it would do well for XYZ reasons. Can you guys help them raise the rest? So we take them through a process. We obviously work out if A, they're eligible, B, if it's appropriate for equity crowdfunding, C, if we think that there will be sufficient demand from both our audience, so we've got about 50,000 investors on the platform, and then the company's audience and networks. So something that's sort of not necessarily widely understood or people are aware of, that, and this statistic's pretty well trodden out globally, is about 60% of the investors by number will come from the first 3 degrees of connection to the company. So it could be your cousin, it could be a mate whose friend heard about it, something like that. But a lot of the investors by number in equity crowdfunding will come from those 3 degrees of connection to the business. The other element and what we bring often might be the larger sums and larger investment. So, obviously we help companies put together a regulated offer, distribute it, go through the process and tap into their networks, but then Equitise and our investors will invest, and obviously, there's an element of wholesale sophisticated investors putting in larger sums and your retail investors putting in the $250, $500.
That sounds like, we just posted a link, by the way, if you do want to get access to the platform, click it, or if you want us to pass your name over to Jonny, just type in yes, we can get your details over. Speaking about numbers, generally speaking, so, you've sort of done the comparison of different companies. So if you're a listed company, you're typically buying a dividend. Mm-hmm. What kind of returns do you think an investor, and I know this is obviously, you've got to, with all the regulatory hat on, but what kind of returns do you get from companies? Are there some specific examples of some stocks that have went the journey now over the last 5 years that have done really well for clients?
So on paper, we've had companies, and as I alluded to, I think we've had 13, 14 companies do follow-on rounds at an average increase in valuation of 130%. So that's not too bad. But it takes
pretty good.
Yeah, look, it takes a bit of time, and often the companies might raise 2 or 3 further rounds before there's either a listing or an acquisition or some sort of liquidity event. So it's very hard to say. It's anything from losing your money to making many multiples of your money. Depending on the company. Again, we've done 83 raises for about 75 companies. It will take time, and we're starting to see a bit of a cohort analysis. So the very second company we raised money for out of New Zealand, they're kind of like a challenger for New Zealand. They're a variable annuity provider. They're doing really well. We've raised money for them 5 times now. Probably going to raise money once more before they look to list in the next year or so. And that from beginning to end over sort of 6 years should look like some pretty reasonable returns for people. It just depends on the company, and obviously, as is the risk with all these sorts of things, the companies might fail. So you might lose your investment, which is obviously on the risk-adjusted returns potential. You could make a lot of money, or you could lose all your money. So obviously, it varies significantly with these sorts of companies, but most of them are looking to generate your outsized, 5, 10, 20 time returns sort of thing.
You make it sound almost like it. I mean, obviously there's risk there, but I'll ping you on that in a second. We're just running another poll. What do you think of crowdfunding generally? Or 16% already think that you were the rugby player. So but
I'm sure you got people signing up because they thought that was the case. Sorry, guys.
Yeah. Well, we I think there's a lot of people that are working at the moment, so I'm sure that we'll get a lot more questions over the guys that watched the replays. Yes, it is all recorded. So anyway, just interestingly enough, so you've obviously had some company average return of 130% is crazy. So you've got a couple of other companies that do crowdfunding. I think there's sort of about 6 companies. You're sort of the premier destination for these things. And then for the client itself, for the investor, so there's no subscription fees to your platform, as far as I understand, no brokerage fees on the way in, out potentially if they've listed or there's a secondary market. I mean, that sounds like a pretty compelling proposition for someone to come to your platform and engage with it and learn about companies, do their research, and then ultimately find some investments, right? Like, what am I missing? Am I missing something?
Yeah, look, I mean, we try and make it as easy and as accessible as possible, right? And we do, encourage people to, spend a bit of time, look at a few investments, maybe make a few smaller investments, and work out what they want to do and what their strategy might be. But yeah, we've done it in a way. We're trying to make it relatively accessible. We try and make it apples for apples. So obviously all these companies are very different stages, different sectors. We try and make it as easy to analyze and compare them. But yeah, look, obviously this is risky. We make no apologies about that. But obviously there's the potential for the adjusted returns. And then obviously people need to understand where this might fit in their portfolio, and whether it be, a portion of anywhere from 5% of sort of your alternatives that they might have in their portfolio to, much larger allocation, depending on how wealthy you are and how much you're willing to put at risk or your time horizon, those sorts of things. Mm-hmm. So yeah, look, by all means, it's easy to sign up. You get on our newsletter, you see deals, you can look at them, you can download the IM or offer document and ask questions of the company online, all these sorts of things. So we try and make it as easy and as accessible as possible, so people can start, putting a little bit of money in and testing it out.
So interestingly enough, 6% of people said that replied, "It seems dodgy, but I'm intrigued." What do you say to someone who says, is there something like, obviously, the market pretty well. I mean, it's not really like there's anything dodgy about it. But what do you say to people like that?
Look, I mean, like everything, there's companies that list on the ASX that don't perform or don't live up to expectations or what they suggest they're going to do. Under equity crowdfunding, there's obviously requirements to the directors of the companies, very similar to those of public company directors. They have limitations around related party transactions. They need to provide information, financial statements to investors, all these sorts of things. So look, it's not dodgy. Over time, and as it becomes bigger, and there's now, from those initial 6 companies that were licensed, I think there's almost 15 maybe that now have licenses. There's really 4 or 5 that are particularly active and do too much volume. But look, it all happens in a very open and transparent fashion. So it's kind of hard for anything properly dodgy to get through. And there's a lot of scrutiny. And there's obviously things that we do and processes and checks and balances to try and weed out whatever we can.
And obviously, it's not like it's just, it's not like it's something that, these are companies, they're going through their raising process just through a slightly different means to what typically has only been open to institutions, right? So this is where you get to go in and democratize something and give capability to companies that that potentially would otherwise have to seek institutional help, right? Sure,
yeah. So definitely this is democratizing early stage capital markets. It's making it accessible to everyone. Some companies that traditionally, there's something of, like a little bit of an old boys network in many regards to access investment banking or venture capital for some companies. And if you don't know people, or if you're not well versed in the space, it can be very hard to get exposure and know who the right partners are or who can help you. There are a lot of Sherlocks and charlatans, as I like to call them, in early stage capital markets that, are telling companies that they can help them do whatever. But we're trying to make it more accessible and more transparent and make it available for both investors and companies that are needing to grow and access funding.
Jonny, what you're doing is awesome. Thank you so much for coming on today. We had some really good feedback. So 70% or roughly, unfortunately the numbers just disappeared, but roughly 70% have said that they're interested. Sorry, that was just a question that came through. Is there a lock-in period for investments before they're available to be reclaimed as Equitise? Provide annual tax statements that are tax return ready.
Sure. So under the equity crowdfunding regulations, investors technically can't sell for 12 months. Is a restriction. And then thereafter, it would obviously depend on the constitution if the company is not listed and there's not a direct avenue to sell. And then as to what we provide, so at the point of investing, you get effectively an investment agreement which has all the relevant information. We provide a portfolio section that has an overview of your investments. We don't provide a full tax statement because obviously it's a little bit difficult in this space, and often there's no sort of market price or mark that you can use. So what you tend to do is obviously, unless the company's had a corporate action or something's happened, and in which case the company or the share registry might provide you with some additional information, then you're most likely to say that you're marking it at the cost of purchasing it. So yeah, no, that is an area that's it's a little bit difficult, and we don't provide you sort of full tax.
There are also some tax concessions for getting into early stage investments, CDT benefits, and whatever else. So worthwhile checking those out with your accountant. But anyway, mate, thank you so much for coming onto the show. I did want to ask you a question, which I'm going to have to leave to next time, because it does say on your website that you and your co-founder met at the University of Sydney, and there were stories for another time. I did want to ping you about those stories, but sounds like we'll have to do it next time. Otherwise, you have other things to do as opposed to talk to me. We didn't get to talk about any BDSM either, but that's okay. Thank you for joining us. And diversification, which I think is important. Thanks so much for coming into the show. Keep doing what you're doing, and we'll catch you very soon.
Thanks, Alvin. Thanks, mate.
Cheers. Speak soon. Bye.
Bye.